At some point, the numbers stopped making sense. Not because they were complicated, but because they were too big to feel real. Right now, across the world, money owes money. Not people, not countries, money itself. And the system is quietly pretending this is normal. Here's the uncomfortable truth. The global financial system no longer runs on wealth. It runs on promises. Promises that can only be kept if even more promises are made tomorrow. That's what happens when too much money owes too much money. And it matters right now. Because we're living in the moment when those promises are starting to collide. Let's slow this down. Debt sounds simple. You borrow, you pay back. End of story. But modern debt doesn't work like that. Not at scale. Not when the numbers stretch beyond human intuition. Globally, total debt is now well over $300 trillion. That includes governments, companies, banks, and households. 300 trillion. To put that in perspective, the entire world produces roughly $100 trillion of goods and services per year. So the world owes about 3 years of its entire economic output. And that's just the principle. Interest is where the story turns dark. Because interest means the system doesn't just need to grow. It needs to grow faster than the debt. Every year, forever. Now here's the part most people miss. Who is owed all this money? On paper, it looks like creditors, banks, bondholders, pension funds, central banks. But zoom out. Those creditors are part of the same system. They hold assets that are someone else's liabilities. Money owes money. A government issues bonds. Banks buy them. Pension funds buy them. Central banks buy them. The same dollars circle the system, earning interest from each other, while nothing new is created except more claims on future income. It's like a global game of financial musical chairs, except the music never stops. It just gets quieter. So how did we get here? Not through recklessness, through incentives. After World War II, debt was a tool. It built highways, factories, power grids. Debt created real assets that increased productivity. But over time, something shifted. Economic growth slowed, populations aged, productivity gains became harder. Debt stopped being used to build the future and started being used to preserve the present. Governments borrowed to avoid pain. Companies borrowed to boost stock prices. Consumers borrowed to maintain lifestyles. And central banks made it easier. Interest rates fell, then fell again, then hit zero, then went below zero in some places. Cheap money became normal. Here's the irony. Low interest rates were supposed to help repay debt. Instead, they encouraged more of it. Because when borrowing feels painless, restraint disappears. Why raise taxes if you can issue bonds? Why cut spending if markets keep lending? Why slow down if asset prices keep going up? Debt stopped being a temporary bridge. It became permanent infrastructure. Now let's talk about the math no one likes to say out loud. If debt grows faster than the economy, it can only be sustained if interest rates stay low, very low, because even small increases in rates cause massive jumps in interest payments. A government with $1 trillion in debt doesn't flinch at 1% interest. At 5%, everything changes, budgets crack, spending gets crowded out, political pressure explodes. That's why rising rates feel like panic. Not because borrowing stops, but because the illusion of control breaks. This is why central banks are trapped. They're supposed to fight inflation by raising rates, but raising rates threatens the debt structure they helped build, so they walk a tightrope. Too low, and inflation eats purchasing power. Too high, and the debt math collapses. This isn't theory. We've seen it before. Japan has lived inside this reality for decades. High debt, low growth, near zero rates. The system survives, but it doesn't thrive. Europe flirts with the same fate. So does the United States. Now let's address the public story. You're told debt doesn't matter, that governments can always print money, that modern monetary systems are different. There's truth in that, but it's incomplete. Yes, governments can create currency, but they can't create trust. And debt is ultimately a confidence game. As long as people believe future income will exist, the system holds. The moment that belief weakens, everything speeds up. Capital moves faster, currencies weaken, inflation becomes political, and suddenly, debt that looked manageable becomes radioactive. Here's where it gets quietly absurd. When debt levels are too high, the system needs inflation to function. Not runaway inflation, just enough to shrink the real value of what's owed. Inflation becomes a feature, not a bug. It transfers wealth from savers to borrowers, from fixed incomes to asset holders, from the patient to the leveraged. And most people never vote on it. They just feel it at the grocery store. Now zoom out further. What happens when everyone tries to reduce debt at the same time? Governments cut spending, companies stop investing, households tighten budgets. Sounds responsible, but collectively, it causes recessions. Less spending means less income. Less income means debt becomes harder to service, which leads to more cuts. This is why systems built on debt resist deleveraging. They prefer inflation, growth narratives, and financial engineering. Anything except saying, we borrowed too much. So where does this leave us? Not at the edge of collapse, but inside a system that can't go back to normal. High debt means lower future growth. Lower growth means higher dependence on policy intervention. Higher intervention means less room for mistakes. Every cycle becomes more fragile. Every crisis requires bigger responses. And the quiet risk isn't a dramatic crash. It's stagnation, volatility, a future that feels constrained even when markets look strong. The final irony is this: the system survives by doing the one thing it claims to avoid. It keeps borrowing from the future. So here's the question worth sitting with. If money keeps owing money, and the future keeps paying for the present, at what point does the future say no? Not with a crash, not with a headline, but with a slow, irreversible shift in how much this system can give back. That's not a prediction. It's the unresolved balance sheet we're all living inside.